Thank you, Stacy. Good morning. Good morning across the United States, listening to our webinar on financial tax procedure and procedural aspects of a dental practice sale. Welcome. Happy Veterans Day. And before I introduce myself and my partners in crime here, I want to personally, on behalf of all of us at Eide Bailey and Bank of America, I want to thank all of you who are veterans or who have relatives who are veterans for everything that you've done to protect our country on this Veterans Day. Thank you so much. We have a lot of information to present to you today. As an overview, folks, first of all, my name is Art Wiederman. I am the Dental Division Director at the CPA firm of Eide Bailey. I'm located out of Tustin, California, and I'm trying to advance my slides here. Stacy? It is giving me a, yeah, it's not letting me. There we go. Okay. So my name is Art Wiederman. I'm the Director of Dental Practices at Eide Bailey, LLP. We work with about 1,000 dentists across the Western United States and about 300 in our office in Tustin. My co-presenters today are my Dr. Bogdan Madurowicz, who's my partner in our dental practice brokerage. I've been a dental CPA for 38 years, and I have also run a dental practice brokerage for 17 years. And you'll get to meet Dr. Madurowicz. He is a retired dentist. He practiced for over 30 years in San Diego. And Dr. Madurowicz is going to have some great insight today into the dental part of the sale of a practice. What is it like psychologically when you're getting ready to sell? What should you be looking at in the inner workings of your practice to give it the best value? And then we have my good friend Justin Klingshirn, who's the Vice President of Dental in the Dental Division of Bank of America Practice Solutions. They are the largest dental lender in the United States. And Justin is going to give a piece of this presentation to talk about financing. So I want to just share, let's see. It is just not being friendly to me in advancing these slides, Stacy.
All right, hey, let me stop sharing and we'll reshare and see if that helps. Okay.
Let's do that. I'm sorry, folks. So as Stacy is doing that, just a couple of things I want to point out to you. Number one is we are going to have 2 additional webinars here. You've given me control. Okay, let's see. It is not. It's not. Yeah, yeah. Why don't you take control back, Stacy? I'm just going to have you advance the slides.
Okay.
I'm sorry. So a couple things. December 2nd, put that on your calendar. We're going to do a webinar on year-end tax planning with Mel Schwarz of our National Tax Office here. And on December 9th, we're going to do the 3rd of our transition series. This is the 2nd of our transition series, which is going to be the ABCs of buying and selling a practice. The 3rd one is Kathleen Johnson, who's going to talk about the management aspects. The first webinar we did was several weeks ago with Pat Wood on the legal aspects. Dr. Madurowicz, Justin, and I are going to talk about the operational aspects of buying and selling a practice. And then we're going to do the management aspects. I do have a podcast called The Art of Dental Finance and Management. We've got a lot of great guests. We've been doing it 4 years now, over 150 episodes. We've got some great episodes coming up. So please log on. If you don't subscribe, you can subscribe. We talk about all kinds of issues for financial and management of a dental practice. Okay, Stacy, next slide. So today we have a lot to talk about. This is, I'm not going to go through every one of these items. We're going to start with a case study. And the case study is going to be, are you ready to retire? Do you have the financial ability to retire? It's the first question that I always ask doctors. Do you have enough money to retire? Then we're going to talk about valuation in the market. We're going to talk about what the banks are doing. That's where my friend Justin is going to be absolutely instrumental. By the way, Bogdan and Justin, good morning.
Good morning.
Justin, you there?
Morning, Art.
Yeah, just wanted to make sure you guys were there and with me and that the technology is working. So Justin's going to spend some time talking about lending. What do you need to know about borrowing money to buy a dental practice? We are going to spend some time today on if you sellers are being approached by DSOs. We're going to talk about that at a very high level. We could spend 8 hours talking about how that works. I'm going to spend 10 or 15 minutes just to kind of give you an overview of what you need to know before, if you choose to do this. Working with brokers, we're going to talk a lot about what you need to look at as far as looking for a practice, what's going to make the practice more valuable. So I'm talking to buyers and sellers at the same time. Dr. Madurowicz is going to give you some information about what it was like to sell his practice. He has gone through this process. So he'll give you some insight along the rest of some of the rest of this webinar. We'll talk about your office lease, due diligence. We'll get to as much of this as we can. Okay, Stacy, next slide, please. All right, so let's get started. So the first thing, now I'm talking to my sellers, and I want to know, the first question I ever ask, someone calls me up and says, Art, I'd like you to sell my dental practice. And my first question is, doctor, are you ready to do this? Are you ready financially to do this? And that's what we're talking about right now. So I just decided to put a case study together. Dr. Wiederman is 65 years old. I happen to be 63, but I've aged a little bit in just in trying to get the technology to work. I've been aging, right? My children are off the payroll. They've graduated from college and are self-sufficient with jobs. I don't own my own dental building. That's a different conversation. So let's say my practice is doing about $800,000 a year with a net profit of $280 before I make a contribution to my pension plan. So I have $220 left that I can go ahead and use to live on. Included in my overhead is $30,000 of expenses, which are currently being paid through the practice. But folks, we all know that you've got your car, and maybe you take some trips, and maybe some stuff goes through the practice. When you don't have a practice, you don't have revenues of $800,000 to go over, okay? You don't have those revenues, so you're gonna have to pay for those yourself. Fortunately, I've saved $1.8 million in my retirement plan. After yesterday's stock market, the Dow went up 1,200 points. Maybe it's a little higher. House is worth 1.2 million. I owe 200,000, and my house payment's 2,500 a month. These are the analyses that you guys should be going through if you're selling a practice. Okay. The practice's price is $720,000. It's 90% of gross because it's in a very desirable area. Beautiful office. It's got all the toys. We're going to talk about valuation at length here. I currently have living expenses of $14,000 a month, or $168,000 a year. What I'm going to do is I'm going to live on $12,000 a month in retirement because I'm going to use the practice proceeds from the sale to pay my mortgage off. Next slide, Stacy. So here's the analysis. I'm now going to put my financial planner hat on. I taught the Certified Financial Planners course in taxation for 3 years here in Southern California. Rule of thumb, folks, if you have a retirement plan and you plan on pulling assets from them, you should plan on pulling somewhere between 4 and 5% of your nest egg every year so that your assets will not go away before you pass away. That's the rule of thumb. And where we get that from is the stock market historically, where most of you have your retirement assets, historically returns 7 to 9%. Now, again, we know the stock market has been very volatile for lots of reasons, which we don't have time to get into. You take that 7 to 9%, you reduce inflation. Now, we know, if you're listening to this, you're going to say, Art, don't you know that inflation is 8%? Yes, I do know that. But historically, over the last 50, 75 years, and especially the last 10 or 15, inflation has been 2 to 3%. The Federal Reserve is working on bringing that down. It will come back to where it was. It may take 12 to 18 months to do it, but it will. That's just how our economy works. So if you take the 7 to 9% minus maybe the 3% to maybe 4%, you get 4 to 5%. So of my nest egg of 1.8 million, 4.5% of that is 81,000. I'm going to pull that 81,000 out of my retirement plan, and I'm going to use that to live on. my Social Security income. Now, for those of you who are, most of you are not drawing Social Security unless you are over full retirement age, which is 65, 66, depending on your date of birth. So Dr. Wiederman is going to draw 21,600. Mrs. Wiederman is going to draw 14,400. So that's a nice thing, you know. You pay into Social Security, and when it's retirement age, you can start drawing it. I have $10,000 a year from personal investments. Maybe I have a rental property. Maybe I have some stocks and bonds that throw up dividends. So my total income is 127,000. So what do I need in retirement? Remember, I told you I want to live on 12,000 a month or 144,000, but that's not it. I need 30,000 for all those, the car expense, the travel expense, the this, the that was being paid through the practice, because once I sell the practice, there's no practice to run it through. So I'm short. I need 174,000. My income's 127. So I'm short about $47,000. What do we do? Next slide, Stacy, please. I have choices. I can continue to work part-time during retirement. If we have time to get to the slide on selling your practice and working back, doctors, I'll cover it. If not, I'll give you a preview. I have run the numbers 47 ways to Sunday. And in order to be able to sell your practice and have enough money for the buyer to be able to live, pay their bills, pay their note payment to the bank, and to pay you an associate fee, your practice needs to be doing about 1.3 million. So if you are doing 600,000 or 700,000 and you think you're going to sell your practice and work back 2 days a week, the numbers don't work. So you can work part-time during retirement. You can either work in your current practice back for the buyer, or you can go out of what's called the covenant not to compete area. When you sell your practice, you sign a covenant not to compete, which is usually 10 to 20 miles. And if you go, you know, maybe you move to another state, you get a job somewhere working a couple days a week. Cut your living expenses. Ha, ha, ha. Good luck with that. You know, you could try and cut your expenses. Most people don't wake up the day they retire and say, okay, I'm going to cut my living expenses 30%. Doesn't work that way, but you could. You could sell your home and move to a less expensive home. Okay, that generates more assets. Now, for those of you who might be listening in the Midwest, that may not be as much of an option. For those of you listening in Southern California, where home prices, and Northern California, where home prices have gone absolutely crazy, that is an option. We have doctors that have sold their homes, pocket $1 million, $2 million, and they use that for retirement. They move into a retirement community, etc. Or maybe you work a few more years and you save more money. Maybe you cut back to 3 days a week. Maybe you do the procedures that you enjoy doing. Maybe you get rid of the patients that make you want to just blow your office up. Those are options. So these are the things, doctor, before we even start talking about selling your practice, that you should consider. Next slide, please. Okay, so now I want to cover kind of the general atmosphere for what's going on 2022, 2023. So right now, we are in an economic, I mean, the stock market has gone down 20%. Forget about what happened yesterday, because the day before, the Dow went down 600 points. It went up 1,200 points yesterday. But the markets are generally down 20%. And I have had several doctors who were talking about selling call me and say, you know, Art, my 401k is now about a 2.5 1k. So I may want to hold on for a couple more years. You know, the financial markets are down. Fear of a recession next year. Quickly to talk about that. The Federal Reserve continues to raise interest rates, And what everybody is afraid of is that because interest rates are going up, people are it's going to be more expensive to buy stuff. It's going to be more expensive for companies. Companies are going to see demand go down, which is what the Fed wants to cut this inflation. They want demand to go down, but when demand goes down, it could throw us into a recession. Most of the pundits believe that a recession would be mild at best, but you know, we don't know what's going on. There's a lot of factors that go into that. So those two factors at the top tell me that there may not be as many practices on the market. Fewer practices means higher prices for the good practices. And I know that Justin is going to cover this in his presentation, but the bottom line is, guys, good practices are going to sell for high multiples, bad practices are not. And that's going to be a theme today. This is a big deal. We're going to talk about this. Corporate dental groups are out there buying practices. I mean, they are out there, they're coming. If you have a practice, you may have already received a phone call. We're going to talk about that at length. That's a factor in all of this. You know, for all of my years of practice as a CPA and a broker, we've always worked with single doctor practices selling to single doctors. And we have always wanted to perpetuate the private ownership of dental practices, hopefully fee for service. We know PPOs are a huge deal. You know, corporate dental groups are out there. They are buying practices. It is real. And we're going to give you some information to be prepared for that. Delta Dental is a big issue, but it does not affect valuation. We'll talk about that a little later. Buyers are more detailed. They're more skeptical. They're nervous. Interest rates have gone up a little bit, Justin. We'll talk about that. If you have a profitable practice, it's a great time to sell. There are buyers out there that want to buy good practices. And I believe that there always will be. And like I say, good practices will sell for a good price. And there are doctors that want them. Next slide, please. All right, so now I'm going to talk a little bit about banks, and now we're going to kind of get into Justin's area. So Justin, as I kind of come in here, if you want to touch on this or, you know, wait till I give you the slide presentation to make on your own. Justin's going to give his own presentation here in a minute. So just some points about what the banks are saying. They're not like in practices that are under 500,000. A lot of them don't cash flow. It's difficult for them to justify a buyer being able to make a living. So be aware of that. You know, now that the pandemic's behind us, we have all of 2021, which for a lot of you was really, really good. And most of 2022, which has also been, for most of you, really, really good. You know, practices have issues right now. We have high overheads. We have inflation that has increased the cost of paying employees if you can find them. That is the biggest issue right now in dentistry. We all know that, is finding and retaining good team members. And I was talking to a specialist the other day who said to me, Art, I've practiced for 30 years and I've never had to pay, and this is in Orange County, I've never paid more than $25, $27 an hour for somebody to work for me. I can't find anybody for less than $35 an hour. And we're hearing that a lot. The PPOs are a huge issue. Again, we're not getting into those today, but think about it, doctor. If you're a business and 70% of your patients are contracted with insurance plans and your costs are going up, you can't raise your prices on 70% of your revenues. That's not a great business model. That's another discussion for another day. Staff turnover. So we have issues going on. The banks know about that. Banks will generally lend, and we'll get into this a little more, 75 to 95% of the prior 12 months collections, including working capital. To go over 90%, I mean, this has got to be a rock star, superstar practice. Banks have money. They want to make loans. Justin, did you bring your briefcase today with all the money in it to show everybody?
Yeah, it's here. Yeah, it's under my seat.
So Justin's got it. It's a huge brief. I've seen it. It's like lots and lots of money to lend to you guys, but they're not just going to give it to you. So we'll talk about that. Next slide, please. So buyers, you know, most of the time, Justin will talk about this, in many, many cases, the banks will finance 100% if the numbers work. And that's what Justin's going to talk about. Sellers are generally not willing to carry a note. If you have to carry a note, doctors, what I say to you is, okay, I'm not a fan of it, but just make believe that you're never going to see that money. And if you do, it's a bonus. Some banks will go above the limits if the practice cash flows well. You know, if you're looking at a practice that you really like, but the cash flow is bad and you need 100% financing, talk to Justin. He'll tell you, you know, what he can and can't do. I mean, if it were up to Justin, he would give every single one of you tons of money to borrow to buy a practice, but it's not quite up to Justin. It's up to some other people who work with Justin called underwriters. So he'll get into that. And if you had a good 20, 21, 22 sellers, you should be able to get your practice finance. Next, please. All right, and it's about time to turn this over to Justin. I just want to make a couple of points. If you are looking to buy a practice, doctors, I would strongly encourage you to talk to a dental specialty lender, and Justin will tell you why. They understand your business. They are geared to make the loan. They have looked at hundreds, if not thousands of practices, and pretty quickly, Justin can tell you what you'll qualify for and what he can loan into practice. Buyers, make sure your credit is pristine. Kiss of death, missing a house payment, missing car payments, high credit card debt. Justin will talk about that. Justin's going to talk about what you need to be able to produce in order to do this. Doctor, if you've never produced more than $20,000 a month in your life and you want to buy $1.5 million practice, we need to talk. Pre-approval, let Justin cover that. Verify the debt in your practice, sellers, because if you don't know what you owe and you're expecting X number of dollars, when Justin, the bank or escrow runs the lien search, you might have a big surprise. And remember, accounts receivable is generally not included. So let's go to the next slide, and then I'm going to turn this over for a few minutes to my good friend, Justin Klingshirn from Bank of America. Bank of America, as I mentioned, is the #1 dental lender, the biggest dental lender in the country. They've financed thousands of practices. Justin is here out of Southern California. So Justin, it's all yours. And I guess Stacy has control, so just ask Stacy to advance your slides.
Yeah, no problem. Thanks, sir. I appreciate it. You can hear me okay, right?
Yes.
Beautiful. Just making sure Stacy can go ahead. So again, my name is Justin Klingsher, and I've been with Bank of America for about 10 years, and all that I do is financing to dentists. I've worn a couple different hats, and I've covered a couple different markets. I started in Ohio, was there for a year, then moved to Texas, covered a 4-state territory, doing acquisitions, then switched to projects for a little bit, then back to acquisitions. And then I moved over to Southern California right before COVID. So I've been here for about 3 years right now, although I do work nationwide. Today, I'm going to talk to you really about two things. One is through the eyes of an underwriter, like what a bank looks for in a buyer. It's valuable for both a seller and a buyer to know that, in that, the seller should understand the buyer's perspective, what they're going through, how a bank underwrites, how financeable is your practice to them. And then secondly, it's more or less meant for buyers, which is the Rule 50. Why we encourage ownership, if for anything, how financially beneficial it is as compared to working as an associate. So I'm going to start right here. Financial assessment for banks and buyers. So look, while to a seller, the bank isn't within that tight group of people that you'll have to surround yourself with, a broker, a CPA, an attorney. You're going to have to interact with the bank sooner or later, and the bank might ask you for at least those first two things: the last 3 years of business returns, a P&L. We might ask for a collections report. We might ask for a production by provider report in the event one doctor is producing more than another and that doctor is in fact staying on. We'll get an evaluation or a practice profile. Procedure breakdown. We want to make sure that our buyer has the ability to replicate the procedures done in that practice. An insurance payments mix. Art's going to touch on this, the Delta Dental thing. We will discount some of those revenues. Does it affect value? I'll let Art speak to that. I don't know that it does all that much, but at the end of the day, that is a consideration. And then a W-2 for an associate or a staff that's in the office that might not actually be working in that role. So Stacy, you can move to the next slide. All right. So I've had this conversation like 5,000 times, right, with a buyer. So I go over the same thing every time. So for every buyer gives me a call or wants to meet in person, I say, look, we look at 4 things as a bank. We look at credit, production, liquidity, and then your monthly debts, okay? Credit's a go or no go. You have a 700 or above, you go. You don't, get to work on it, come back, let's try again when it's over 700. Production. You have to produce or show that you can produce at least $40,000 worth of dentistry per month, or about 75% of what that seller was producing in the event it's a large practice. Now, we run into trouble here with community clinics or doctors that only work part-time because banks can't establish that you can replicate any of that production that a seller does. This is a pain point. So make sure as a buyer, even if you have like a quarter where it was a banner quarter, right? Maybe you did $60,000 of production in Q2 of 2021 or whatever, go back and save those as soon as you can without drawing red flags from your employer. Understandably, this is a fragile topic. You have to be sensitive to it. You don't want to give off any warning signs that you might be looking to go, but needless to say, this is something that always comes up, and it does haunt about like 20% of doctors out there. Liquidity. We really didn't look. Then we did, and we were pretty tough on a 10% liquidity, just toll gate. It's down to 5%, meaning if you're looking to borrow $1 million, we want to see that you've saved about $50,000 between just cash assets, marketable securities, stocks. That's not to inject into the deal. It's just to have as a safety blanket. We want to understand, the underwriter wants to understand that you have the ability to save, that you see value in saving. The last bit is student loans and your personal debt. And I'm going to go into more of this, both for the seller's sake and the buyer's sake. I know we have a mix of people on here. Student loans, everybody's got them, right? Most people are on the IBR. We will calculate, within our debt service coverage model, your payment only based on the IBR. So typically student loans aren't going to be a giant factor, right? I mean, oftentimes these payments are, less than $2,000 a month just because that doctor's on the income-based repayment program. And then their personal debt, right? So if they have a giant home, I was working with a doctor, their mortgage payment was $13,000. Well, that precluded them from being able to buy. Yeah, it was high. And what you'll find through the next couple of slides is that makes it very difficult for them to buy a smaller practice, right? As debts go up, those practices become less financeable. And I do think in the greater markets, you're seeing a divergence between the haves and the have-nots, and it's partially because of that. As buyers' debt grow, it takes larger practices to service those debts. So just, Stacey, you can move to the next slide real quick. I put this just to illustrate that debt's growing and it's outpacing inflation of 141% since 1996. The number of pre-dental students in universities continues to rise year over year. We had more pre-dental students this year than we did last year, more last year than the year before. Obviously, when demand is just outpacing supply of the dental degrees, debt is going to grow. Universities, all the endowment funds, they have no issue charging more money for these schools. So this has become a fact of life. Lenders understand it. I only put it on there because it's good for sellers to see how much debt, sometimes literally seven-figure debt loads by these specialists in California. But it's important to acknowledge that this is something, as a seller, you really didn't have. And if you did, you were able to pay it off within a matter of years. Buyers have this burden of student loan debt. And it's something to consider because while you might think your practice is profitable, understand that a buyer that buys it needs to borrow money from a bank and already has student loan debt. So that can burden the cash flow of your practice. I'll touch on that in the next slide, Stacey. This is a super high level example of a cash flow, okay? Now, what is a cash flow and what is a debt service coverage model? Think of us taking in the numerator the net income of the practice, basically the seller's discretionary income. And in this case, we calculate that by taking the practice profit, adding them into the owner's compensation, say the seller paid himself $100,000, adding back depreciation, the auto expense, the interest. This is with no add backs, right? No spouse that wasn't really working in the practice. In this case, we had a net income of $270,000. And then you take the buyer's debts or living expenses, right? In this case, well, they're going to have to buy the practice for, let's just call it, see if this practice is, let's call it $600,000. On an annual basis, that's a $49,000 payment. Let's assume that they got a home and their payment's only $2,000 a month, $24,000 a year. Student loan, same thing, $24,000. Add in their car, taxes on that income and their living expenses. Well, they have a total debt load post-acquisition of $196,000. All we do is we divide the net income, the practice, by the buyer's debts or annual living expenses, plus that loan that it's going to take to borrow the practice, right? That is the debt service coverage. We need that number, and in this case, it's $1.38. It's 1.38. You're making $1.38 for every dollar in debt and living expenses you have. We need that number to be above a 1.2. Why this is critical to understand is it helps sellers frame up why potentially their practice, right? If you look at the left-hand side of this, the numerator side, you said, okay, well, let me calculate what my practice is throwing off as far as cash goes. As you can see, this buyer, they have $196,000 that they need in net income just to pay their debts, and their home mortgage is $2,000 a month, right? Most buyers today, if they own a home, are paying $4,000, $5,000, $6,000 a month. So as you can see very quickly, today's buyer takes a little more cash flow in order to service some of those debts. Now, the bank has additional products to help some of those lower end, just smaller practices get over some of these humps. I can get into some of that offline, but I think this is important to understand. Stacy, you can move to the next slide. All right, this is the last bit. I think this is an incredible thing to speak to. You see DSOs and dental schools left and right talking about how difficult it is to buy a practice, how you couldn't even how a bank would never give you money to buy a practice, and how it just, it doesn't make sense financially for you to do it. I just want to go over an example of two doctors, call it Dr. A, Dr. B, and they both produce $50,000. Taking the associate for one, again, $50,000, you're producing $600,000 annually. You're paid 30% of collections. You're making $180 before taxes. Let's assume that you're just taxed at 30%, understandably here in California. A little bit higher than that, you're making $126,000. I want to compare that to the owner. A $50,000 a month producer is producing $600 annually. Now let's assume that practice is about a third hygiene. That's a $900,000 practice. You assume a 40% margin, you're at $360,000 in net income. Now you've got to make your loan payment. That backs you down to $272. And if your tax is the same rate, you're at $190. Now, while that might not seem entirely different, if you just take these two examples and you fast forward 10 years, what you'll find is obviously the associate, this is easy math to do, $1.26 million. You compare that with the earnings over 10 years for the owner, they're at $1.9 million, right? And even that, if that's not all that drastic, it's important to understand the fact that you at that point as an owner will have a practice that is paid off in full under these assumptions. You have a practice doing $900,000. Art and Bogdan can probably speak to how much that might be worth in the open market, but let's just assume $700,000, right? And that leaves you then at 2.6 million as compared to 1.26. So your net worth as it relates to your practice is more than double as an owner. And all of the Health Policy Institute surveys and studies showcase that being an owner is certainly, in having more clinical autonomy, it's better in a number of ways, pretty much in any measurable way. Work-life balance, clinical autonomy, earnings, hours and scheduling, it's pretty clear what makes more sense for most dentists. But from a financial standpoint, I do think it's important to showcase this because a lot of people just seem to be more afraid today of entering ownership. So definitely wanted to touch on that. Now, that I believe is my bit. I appreciate, Art, you having me on, and for anybody that has any questions, I know we're using this little chat box, so feel free to use it, and then I'll let Art sort of delegate the questions.
So Justin, thank you very much. And again, folks, couple of things I want to do. Number one, if you do have any questions on any of this stuff, please put them in the Q&A. We'll be watching for them. I was also remiss before I go back. Stacy, can you advance to the next slide, please? So before we start talking about valuations, I was remiss to mention at the beginning, our webinar series, not only the business of dentistry, but this transition series has been sponsored and not financially, just promoted by the 8 large local dental societies here in Southern California. And I'd like to recognize each of their executive directors, which I did not do at the beginning, but I'd like to do it now real quick. Leah Deshian from the San Gabriel Valley Dental Society, Greg Orloff from the Los Angeles Dental Society, Kurt Thornton from the San Fernando Valley Dental Society, Megan Francis from the Orange County Dental Society, Michelle Schneider from the West Los Angeles Dental Society, Kristen Avina from the Harvard Dental Society, Laura Peterson from the Tri-County Dental Society, and last but certainly not least, Linda Lacuzna from the Santa Barbara Ventura Dental Society. Folks, please lean on your local dental societies, your CDA reps. They're all here to help you. We want to provide, great information, not only on transitions, but all topics that involve business to help you to be more successful in these very challenging times. So Justin is going to be on with us again. If you have any questions about financing or anything, drop them in the Q&A and we'll get to them. So how do we value practices? So, I like to make things easy. Here in nationally, we generally value practices, and this has been the way they've been valued. And we're going to talk about DSOs in a minute. So let's put those aside. If I'm a single doctor, or maybe a partnership selling to another single doctor or 2 other doctors without a group practice that's involved buying, nationwide, since I got into dentistry in 1984, nationwide valuations have been about 60 to 80% of the prior 12 months collections, except in 2 major markets, New York City and some places in the Northeast, and Southern California. So in Southern California, maybe it's because of the weather. I don't know. Maybe it's because I don't know what it's because, but it's probably the weather that has to do with it. Practices can be 60 to 70%. Valuation of practices are based on earnings, just the same way valuations of stocks are based on earnings. If you have a company on the stock market that's doing really well, that's growing, that has a higher bottom line, their stock price is going to go up. If you have a dental practice that's doing really well, that has good growing top line revenues and net profit, their valuation will go up. But we have practices that are valued 60 to 70%. But mostly in Southern California, for practices that show 33 to 38% net profit, even a little less, not much less, we see valuations upwards of 90% or higher in Southern California. Orange County practices are regularly listed at 80 to 95% of revenues. But we also look at another factor, which is the true net profit. Now, Justin showed you in his slides about how they calculate the true net profit of the practice. And we're going to talk about that. I have a slide later in here that I'll get Justin's input on. Basically, we start with your net profit from your tax return, just like Justin did. We add back the owner's compensation, we add back the automobile, we add back interest, depreciation, amortization, and we get the true net profit. And we multiply that by a factor of somewhere between 2 and 2.5 times true net profit. Most times the 80 to 95% and the 2 to 2.5 times, they come pretty close. But again, everything is different. Every practice is different. Every location is different. If I have a fee-for-service practice, it's going to be worth different than an HMO practice or a Medi-Cal practice. Practices under 500, as I mentioned earlier, they're harder to sell because, if you're a buyer, you got to live in Southern California. I mean, I was working with a young couple as a CPA, and they're thinking about getting married. And I said, if you go out and rent an apartment in Orange County, it's $2,500 a month. And then you want to pay your taxes and pay your living expenses and a car payment, God forbid, right? I mean, as a young couple, you have to make $100,000 a year. And that does not include someone who went to dental school and has student loans of $2,000 to $4,000 or $5,000 a month. So it's, it's harder if you're buying a practice that's less than $500,000. Justin, can I call on you for a quick comment here? Can you jump back on?
Yeah, what's up, Art?
If someone wants to buy a practice that's $500,000 or less, don't you many times say, hey, I need you to work as an associate for a day or two a week outside? Do you do that?
Yeah, we do. So we do that under the Jumpstart model. I'd reference that in that if you have a practice and it's been declining in revenue and it meets certain other toll gates, we will give you credit. Within that cash flow analysis, we can bake in part-time work as an associate, providing that practice is at least not open 5 days a week, right? And that buyer has the ability to go out and produce outside of that practice. That is right, in short.
Okay, thank you for that. Specialty practices are a different animal. We are seeing a lot of DSOs coming after specialty practices, but if you sell one on your own, endo and perio run in the 50 to 60% range because, again, you're basing it on specifically a referral source. And if you have a specialty practice and 80% of your revenues come from 2 referral sources and they're both 67 years old, that gets tough. Oral surgery is a little higher, ortho is a little higher. So valuation, folks, depends on profitability. At the end of the day, you have a profitable practice, it's worth more. If you don't, it's worth less. Next slide, Stacy, please. You know, the pandemic back in 2020, I mean, practices stopped selling for several months because everything stopped for several months. And then we started going back into the market and selling practices in late 2020. Remember, the pandemic was the second week of March is when it started. And dental offices were closed from about the second week in March until anywhere between the second week in May and the end of June, depending on what part of the country you're in and what you decided to do and when you decided to open up. Now we have 2021 numbers, and most of you did pretty darn well in 2021 and are doing pretty darn well in 2022. You know, sellers, buyers, and banks, they like production that's growing. So, you know, we are back to, I believe, valuations that are pre-pandemic, because now we have virtually 2 years of numbers that we can rely on to see how this practice is doing. Next slide, please. Okay, so I'm going to take a little detour here, folks. I want to again let you know that I am a believer in the private practice of dentistry. Single doctors operating dental practices, controlling their own destiny, running their own teams, doing their own marketing, all this stuff. The reason that I have inserted this part of the program, which I've never done before, is because DSOs are real. They are there. There are hundreds of groups out there, anywhere from the largest group practices out there, to groups of 5 to 50 doctors. So what I want to do is I want to give you a 35,000-foot corporate overview of DSOs and what's going to happen if and when, and I'm going to say when for many of you, they come knocking on your door. You might get a call from a DSO saying, hey, we are looking to add to our group a practice in city XYZ, and we would like to talk to you. Or you might have a friend of yours that said, oh my gosh, I just sold and this was great. You should talk to these people. So let's look at this. First of all, they are going to offer you, when they make an initial offer, a DSO, a higher practice valuation generally than if you sell to an individual dentist. However, and you see in capital letters, you need to peel the onion back, and we're going to talk about that. It will allow you to take some money off the table now. You don't have to sell your entire practice to a DSO. You can sell a part of it, 75% of it, and keep part of the equity. We'll talk about that in a second. The theory of going with a DSO, you see my voice went up, the theory of going with a DSO is that it will allow you to alleviate the management burden and improve your work-life balance. Doctors, I will tell you right now, if you believe that you're going to sell your practice and literally the next day you're going to walk away and not have to deal with staff issues, not have to deal with IT issues, not have to deal, you're mistaken. But again, it depends on who you sell to. Economies of scale. If you sell to a large DSO, they're going to have better buying power if you have PPOs. They're going to have better buying power if you have are buying supplies, or you work with labs, or you buy office supplies, that they can probably get better prices on paper clips. So that's another advantage. You will be able to continue to work in your office long-term following the closing. The DSOs, if you choose to deal with them and sell to them, they're going to want you for 3 to 5 years. If you don't want to, if you want to sell to a DSO and you don't want to work back, that changes the narrative, might change the valuation, might change it if they even want you. And wealth creation, which is we're going to talk about in a minute, is that you might get the opportunity to participate in some recapitalization events. So next slide, Stacy. So what are the DSOs looking for? What types of practices do they want to buy? There are 200,000 dentists in the United States. Right now, we believe that DSOs, group practices, consist of somewhere in the 20 to 25% of practices in the United States. I could be off, it's like Steve Kornacki on, on CNN. He says, I think so-and-so is going to win the House and the Senate, but I'm off by 10%. So give me a little bit of wiggle room. 20 to 25% is what I am hearing. DSOs are looking for larger offices, at least 5 treatment rooms, but they're looking for bigger. They're looking for 8, 12 treatment rooms. They are not looking for $500,000 a year practices. They're looking for at least 1.2 million and up. There are exceptions. They're looking for what's called EBITDA, which we have a slide on next, of at least $250,000. They want to turn this practice into a one-stop shop, bring all the specialty in. They want to bring in the endo, they want to bring in the perio, the oral surgery. They want to bring in ortho, Invisalign, sleep dentistry. They want to do everything, right? They want the seller, as I mentioned earlier, to work back for 2 to 5 years, okay? And they are generally looking for locations within 30 miles of major metropolitan areas because that is where the patients are. They don't want to buy generally a practice in a town of 5,000 with no other town within 30 miles because it's difficult for them to scale that practice, because the DSO's game plan is to take your practice, help you manage it and grow it from $1.5 million to 3 million, so that down the road there could be an exit event. Next slide, please, Stacy. So we value practices in my world of selling from one doctor to another doctor based on a percentage of gross revenues or a multiple of profit, true net profit. When valuations happen in a DSO world, they are done based on EBITDA. You have all heard the term EBITDA. It's not a funny word that I just made up because I want to look like I'm smart, I promise. What it is, it's earnings before interest, depreciation, taxes, and amortization. And we're looking for an EBITDA of 20 to 25%. So remember, if I'm selling a practice, I'm looking for 33 to 38%. If I am selling to a DSO, we're going to value EBITDA. And I'm going to show you how that's calculated. I have an example. Every deal is different. Let me be very clear. Every deal is different. Did I say every deal is different? Yes, every deal is different. Practice with an EBITDA of less than $1 million, we're seeing 5 to 7 times EBITDA. Over $1 million, could be 7 to 10. It could be less. It depends on the EBITDA. So the way that the DSOs are offering to buy your practice, doctor, is that they're going to offer you a substantial amount of the cash value up front. 50 to 80% of the value that they come up with of your practice. And then they're going to offer equity in what they call the mothership. I'm going to show you all of this as an incentive for you to stay on. So let's go to the next slide, please, Stacy. What are the factors that impact how the DSOs value your practices? The profit level, again, 20 to 25% EBITDA. How many locations? You are probably going to get a better valuation if you own multiple locations than if you own one. How many doctors do you have? How many of them are going to stay? Geography. Are you in an area where they're building 5,000 homes? That's going to help. What's your payer mix? Is it fee for service? Is it HMO? Is it bad PPOs? What's your service mix? Are you doing all crown and bridge, or are you, I had one doctor as a CPA 20 years ago who wanted to become a client of my CPA practice. And they said, we refer out all crown and bridge work. We just do fillings. And I said, you didn't just say that to me. And they said, yes. I said, okay, that's the only time I've ever heard that. Are you doing a lot of crown and bridge? Are you doing Invisalign? Are you placing implant? I mean, what's your mix? What's the doctor's plans? How long is the doctor going to stay post-closing? That's going to affect the valuation. And the owner's personality. This is a big deal. I've talked to DSO brokers. I've talked to, one of the DSO brokers I work with, Justin and I know very, very well. And he shared this with me. DSOs are big business, and they do not want to deal, and I'm going to use the term, with prima donnas. They want to deal with doctors who are going to buy into the concept of everybody wins. Let's take care of the patients. Let's make money. And they don't want to deal with doctors who are causing problems. So, doctor, if you're going to go into this with a combative attitude, this may not be the way to go for you, if this is the way you want to go. Next slide, please. So this might be the most important slide in this section. What do you guys need to think about? Do you want to retire, or do you want to keep working? If you have a practice, you're 67 years old, you like dentistry, you're getting tired of all the management, you see an opportunity, and maybe you want to work for another 2 to 4 years, it could be for you. You want to talk to doctors, if you choose to do this, who have sold to the DSO, and how are they doing? And this is the big deal, the big one, the third point. How do you feel about giving up control of your practice? Are you going to be afraid that every morning before you go to work for the next 3 to 5 years that you're going to have to throw up? Are you going to just not enjoy it? Or is your practice going to be turned upside down? You don't know that. You will lose control of aspects of your practice, no matter what a DSO tells you. What about your team? Doctors, one of the things that I've loved about working with dentists for 38 years, since 1984, is that dentists are some of the warmest, kindest individuals I've ever met. I'm proud to call many of them my good friends. And the fact is that many of you have operated your practices not as a business that has to make money, but as a family. I mean, you are friends with your team members. There's hugs in the office. You go to the weddings and parties of your team members. You're a family, all right? If you go and sell to a DSO, that's all going to change. How are you going to feel about that? All right? So my advice here is that if someone calls you, do not just start negotiating with them. There are brokers out there who specialize in helping to take a practice to DSOs, and offline we can certainly have that conversation. We can help with that. We work with them. And you don't want to just go to one place. You want to put this out. If you make the decision to go this route, you want to make the decision and put it out to many suitors. You wouldn't sell your house to somebody who called you up and said, I want to buy your house, and not consider other offers, right? I, as a broker, if I were selling your practice to another dentist, wouldn't just say, oh, well, you're going to sell to this one person. You want to put it out to many people. Next slide. So EBITDA stands for, like I say, earnings before interest, depreciation, taxes, and amortization. It's basically the income an investor can expect if the investor buys a practice and is not the practicing dentist. It's the true net profit that Justin showed you that I talked about, minus your operating expenses, the true revenues, minus the expenses, and then reducing that by a reasonable salary that is going to have to be paid to the owner doctor, because if a DSO buys the practice, they have to pay the owner doctor a salary or a replacement doctor a salary. Whereas if an individual doctor buys a salary, I don't have to, reduce it by that, because that is profit. And we can literally spend days doing this. We're not going to do this. I am going to, in the next slides, give you a very Very high level, simple example. Next slide, please, Stacy. So Dr. Wiederman has a 10 treatment room dental office. I had gross revenues for the last 3 years, pretty steady, $3.5 million. My true net profit after adding back my operating overhead, including associate salaries, owner salary, all this stuff, is $875,000 or 25%. The larger practices have larger overheads for lots of reasons. Included, I have 2 associate dentists. Neither one of them want to buy the practice, but they'd like to continue working. The DSOs like that. I'm 63, which I am. I'm in good health. I'd like to work another 3 to 5 years because I love dentistry. I love what I do. And I'd like to get some help with some management issues and my practice. I do about $600,000 a year, and fair compensation for me about $180,000 a year, 30%. Next slide, please. So here's a very simple DSO valuation. Revenues $3.5 million, overhead of 75%. Again, it's a bigger practice. I have associates. If I didn't have associates, my overhead's going to be 63 to 68%. But I have the associates, so that drops my overhead, increase my overhead to 75%. And then I take my salary out. So my EBITDA is $695,000. Now, in this example, I was very conservative. I know in the last slide, several slides ago, I said that, practices over $1 million or 7 to 10, but I used a 6 EBITDA here just to make the example. So the DSO might come to you and say, we're going to offer you $4,170,000 for your practice. Wow, that's about 120%. I can't sell your practice to another doctor individually for 120%. Justin, are you going to finance 120% of any practice sale? Probably.
Yeah, I'm glad you brought that up. To expand on that, the answer is no, right? We will only go up to 100%, and that's with working capital. But it's important to acknowledge the fact that as you go up in revenue, your buyer pool thins out because it's harder to find buyers that can produce $1 million, $2 million. In this case, $2.5 million worth of doctor dentistry. Now, granted, sure, there are associates in there, but banks just become generally more hesitant to lend to just anybody at this dollar mark. So your buyer pool thins, and when that happens, right, it's supply and demand. I mean, prices will go down with reduced demand at that price. So that's where obviously DSOs come into play. Sorry, I just wanted to expand on that a little bit.
No, please. I mean, your insight is invaluable. Thank you so much. So in this example, this is a very typical example that we've seen in the CPA practice because we're getting these phone calls. So the DSO will value your practice at 120%, $4,170,000. It could be 150%. It could be 200%. I don't know. Everybody does it differently, but this is just an example of how it works. So the DSO will pay you 70% of that in cash upfront, $2.9 million. That $2.9 million is about in the 80-85% range, which is about what you would probably get if you sold your practice to a non-DSO, to 1 or 2 doctors, okay? So you're going to get this. Then what you're going to get, and we're going to go through a couple of models of how this could work. You're going to get, if it's a sale for cash and equity in the DSO. So the DSO is forming these sophisticated entities. I call it the mothership. So you are going to have ownership in the mothership. 30% of the valuation is going to go into that, $1.25 million. Next slide, Stacy. So there are different structures, okay? So remember, we said in that structure, 100% is for 4.17, 70% cash, 30% to the mothership. So the structures that they'll do 100% sale. You sell 100% of the practice, but they will hold back money. And the holdback is paid out to you contingent upon you sticking around and making sure that that practice doesn't go in the tank. And it'll have benchmarks, and you've got to read the legal documents. Every deal is different. The second type of a sale that we see is 100% sale with a holding company investment. That's the mothership. Again, sellers getting 50 to 80%. My example was 70% cash up front with equity in the holding company. So what the holding company is going to do is they're going to own 25, 50, 100 practices. And then what they're going to do is in 3 to 5 years, they're going to package this group of practices and go to private equity or to a larger DSO. Private equity loves dentists because they pay their bills and they have profits. And they're hoping to do this to give you a 2 to 5 times return on your investment. So what did I say? I said, you're looking at about $1.25 million. They're going to say, well, maybe in 3 to 5 years, we can get you 3 million for that $1.25 million or 3.5 million. We just had a client who did an exit. So here was the deal. It was a specialty practice. He got about it was a big specialty practice. He got about 4 million up front, he and his partner, and they got a valuation. They kept about 20% of the practice, which is the joint venture model. I'll get to in a second. But they had $1 million valuation with the mothership. 3 years later, which was in the last couple of weeks, they had an exit event. And the DSO said, well, because of the pandemic and because of this and because my goldfish died and all this stuff, you're going to get the same valuation today as you did 3 years ago. And he had a choice to either roll that into the next sale, the next possible sale, or to take the cash. And he chose to take the cash because why would my valuation go up? They're all different, doctors, okay? The joint venture model is the same as the 100% with the holding company, except maybe you only sell 75% of your practice and you keep ownership, just like you had before, in 25% of your practice. And you would be able to get some money off the table and participate in profits going forward of the practice as it grows and still have equity in the mothership. Every deal is different. Next slide, please. Things to consider. Tax treatment of cash and equity in the mothership. Doctors, you need to come to a CPA or a tax attorney or both that understands these deals. Bottom line, if your legal document says that you are getting a value of $1.25 million in the mothership, and you are getting that in stock or a partnership interest, you have taxable income with no money to pay the taxes. It's that simple. It gets a lot more complex than that. You must get sophisticated tax advice. We at Eide Bailly, we live in this world. We have amazingly sophisticated people who can help you with this, and we have tax attorneys and everybody who can help you with this. The valuation of the exit to another DSO in 3 to 5 years. Have they done a valuation? Have they done an exit event already? It's pretty early for a lot of these DSOs because a lot of this is new in the last 5 to 7 years. Okay, payout of the equity portion or the cash portion. It could depend on the performance of the practice. Look at that. Again, I'm going to make it the point again. You want to work with someone who can take your practice, if you choose to go this route, to somebody who knows what they're doing, okay? But you need to read every single page of the legal document that you're going to sign, because doctors, I have people who have called me and said, Art, I did this and I can kick myself because I didn't read the fine print. This is a very sophisticated transaction. I am not encouraging you to sell to a DSO. I am saying it is real. It is out there. It might be right for you. But again, I'm not encouraging you. I'm just giving you information. Obviously, our contact information, Justin's contact information, Bogdan's, we're all going to be at the end here. We'll be able to help you with that. Okay, next slide, please. So let's move on. And I am now going to engage my good dear friend and partner in our practice sales business, who has been very patient and smiling, Dr. Bogdan Madurovich. Hi, Bogdan, how you doing? You're muted, Bogdan. You're muted. Unmute yourself.
Yes,
You there?
good morning. Thank you for having me aboard.
No, thank you for being part of this. So we're going to go through more aspects of the sale of a dental practice. from both a buyer and seller standpoint. So the first thing, Bogdan, I want to talk about is, and the one thing Bogdan's going to share some of his story with you in a little bit. Dr. Madurowicz, you practiced for 33, 35 years?
33 years, yeah, in North County, San Diego.
In North County, San Diego, and he sold his practice. Is it 5 years, 6 years? How long has it been now?
5 years ago now, yes.
Wow, time flies when you're having fun.
Mm-hmm.
So the big question that doctors ask me, one of them is, do you tell the team? We in our brokerage, we generally recommend that you don't. But Bogdan, why don't you jump into this? What do you tell doctors who are thinking about, do I tell the team? How do they get involved in that?
That's a great question. I get that quite a bit. Art. Every practice is different. Every relationship is different between employer and employees. So there is really no standard rule. You have to measure that relationship, and it's a personal choice. My example, I had, a physical issue that actually kicked me out of practice. So my staff knew that I was selling, and it wasn't a deterrent to the sale. But if you have a situation where, you're of age and you're thinking about retiring, you tell the staff, you give the staff an opportunity to consider, well, should I stay on at the risk of not knowing who's going to take over? So quite honestly, and the recommendation from our brokerage is not to tell them, because you want to maintain this goodwill. And yes, staff carry goodwill, which speaks to value. If you have one staff member leave because they hear you're going to be retiring and selling, then it could cause a cascade of events, and it could cause another one to rethink whether they're going to stay or not. And in turn, if the patients coming in see that there's a turnover of staff even before the sale, they may think something's going on, and they may think that, maybe I should be looking somewhere else if there's some transitions going on. So quite honestly, it is not deceptive really to not tell the staff, although you are not telling them and keeping them abreast. You're actually trying to preserve the goodwill that you are going to be selling.
I could not have put that any better, Bogdan. That's great insight. And we've had all kinds. We have a doctor who absolutely got mad at us and said, wait a minute, I am being deceptive. I can't do that. I can't sleep at night. Right, Bogdan? We had one of that.
Absolutely.
I had another doctor, we just finished the sale of his practice. It was a great practice. He basically involved his main person of 30 years who was like family, like he called her, I don't know if this is good or not, his second spouse. And she was intimately involved. And quite frankly, I couldn't have gotten the deal done without her. So that might be also another issue that you have to run into. So our recommendation, if you can avoid it, is not to tell the team, because if your team starts to scatter, or if they start telling patients, bad things could happen there.
Can I add something, Art? And this is, I think, a very important point.
Sure.
If you decide that the relationship between you and your employees is very high, and you feel that you could trust them with this information, the one thing I would suggest not to do, even if you choose to tell your staff, is to involve them in the choice of the replacement.
Great point.
You're opening it up to a can of worms. It should be only your choice. Don't have them participate in that decision. I think that's really important.
And the other thing I want to share with you, doctors, not only are you gonna not tell your team unless you choose to, and that's up to you, do not tell anybody other than your spouse or significant other.
Mm-hmm.
I will tell you a quick story, doctors. I'm talking about your kids, your cousins, your best friend, nobody. So I get a call from a doctor who was petrified that his team was going to find out. And he says, Art, I got a problem. They found out. I said, it wasn't from us, because we are really good about only dealing with texting and personal emails and portals, and not getting anywhere near the office. I said, how'd they find out? He says, well, I didn't do what you told me. And my 18-year-old niece called up and told the front office, hey, Susie, I want to get my teeth cleaned before Uncle Joe sells the practice in a couple months. Oops. We don't want to do that. Next slide, please, Stacy. So let's get into, and Bogdan, I'm going to call on you to make some comments about this. Number one, and this I think is a number one, buyers ask me, should I buy the house first or should I buy the practice first? If you buy the house first, then, you know, you're pretty much, if you want to live in the community that you're going to work in, you got to buy a practice in that community. Whereas if you buy the practice first, say, this is where I want to plant my roots, it's going to be a lot easier to buy a house. Bogdan, what do you think about living in the community that you practice in? I think you did.
I think it's a definite advantage to live in the community, although the biggest challenge is remembering all the patients' names when you see them at the supermarket. But living within the community allows you to market yourself, what you do, and that essentially allows the practice to grow. But in answer to, you know, whether you buy the house or the practice first, you got to imagine that the practice is the money tree. And if you don't have the house, you have less debt. And Justin will speak to that. You don't have that mortgage, you just have rent. It's going to be more, it's going to be easier for you to acquire the practice if you have less debt.
Right. How much cash flow?
Yeah,
do you
can I?
need? Yes, please, Justin, go ahead.
I want to jump in. I get that question a lot, and I can echo what Bogdan said. I think that one thing to keep in mind, you're way more flexible if you're renting, both from a qualifying standpoint. In the event you find that your rent's too high, well, next year you can move and get a lower lease, right? Whereas the doctor is a $7,000, $8,000, $9,000 mortgage payment. They've been turned down by 12 banks to buy a practice. They're stuck, right? You're stuck geographically as well. You can only really buy a practice within, I don't know, 30 miles as the crow flies of your home. Again, if you rent, you can relocate by. The last thing I want to add is that, look, in regards to renting versus owning, while it's more difficult to buy a practice as an owner, right? Most banks don't like mortgage lenders, small businesses. We do have a home loan doctor program, right? It's as little as 10% down for a home. Own your practice for a year. Anyways, my big thing, especially today with where rates are, if you're a buyer, try to rent first before you buy your practice.
All right, well, that's straight from the man who's got all the money, and he rules as far as I'm concerned. What procedures are you competent in doing? Bogdan, I'm going to hold that thought for later because we have a slide about that. Are you conservative, aggressive, or middle of the road in your diagnosis? If you are very aggressive and everything is a crown, and you're buying a practice of a doctor who has what we call a watch factory. I had a doctor about 20 years ago in South Orange County came to me. He had practiced for 40 years and he was doing $400,000 a year. Now, I didn't want to insult the nice man. He was very, very nice. And I said, gee, I'm wondering, doctor, you've been practicing for 40 years in an affluent community. You're doing 400,000. Have you not been marketing? He says, no, Art, I have a watch factory. I watch this tooth and watch that tooth and watch this tooth. Right, Bogdan? That's a watch factory, right?
You should eliminate that word from your vocabulary in this business.
Exactly. Do you get stuck that the seller doesn't have all the newest equipment? Sellers, do not spend $200,000 putting in a CBCT machine, a CEREC machine, etc. 6 months before you sell. You will not get that back. If you have a house and you add on 500 square feet 6 or 12 months before you sell it, you will get that value of that house because houses are priced based on square footage, etc. Dental practices, you will not get that money back, okay? If you're 3 to 5 years out and you don't have digital x-ray, get digital x-ray. Because the dentists coming out of dental school today do not know how to practice dentistry without using digital x-ray, period. That's how they're trained. Do you want a fee-for-service practice? Do you want a PPO practice, HMO? I mean, we've got doctors who are looking at HMO practices and their first question is, what's the capitation check? And if it's more than a certain amount, they're interested because they know how to make profit in a practice like that. And then, you know, what size of a practice do you want? Are you a parent, mom or dad, who wants to work 3 days a week and spend 2 days a week with the kids Do you have other interests? What, production, number of treatment rooms do you want? So next slide, please, Stacy. We're going to get a little more into that. Let me make just a comment here about working with brokers. Now, I are one, as is Dr. Madurowicz. You don't need a broker. 80% plus of the deals have them. It makes it a lot easier, and let me tell you why. We have experience in coordinating the process. We work with all the professionals, the attorneys, the bankers like Justin Klingshirn and Bank of America, the attorneys, the consultants, the CPAs, who know how that all the issues are considered. It's very time consuming. If you have to handle this in the middle of your practice day, number one, your team's going to find out. And by the way, doctors, when you start the process of selling, you've got to do everything in your power to not change one bit of how you behave, because your team knows you like a book and they will know something is up. And if you're 65 years old, they're going to sit down with each other and say, he's kind of behaving funny. I wonder if this practice is for sale. All right. We have access to hundreds, if not thousands, of potential buyers. You won't have to spend the time on the phone, and you can continue working without interruption. The disadvantage is you got to pay us a fee, which is standard in the industry, 10% of the sales price. So, I would recommend it. It's going to make your life easier, and it's going to get your practice sold quicker. If you happen to have somebody who is working with you, what we do a lot of times, maybe you have an associate that's going to buy your practice. We will do what's called, Bogdan, an identified buyer listing. We've done several of those. You don't want to go through all the paperwork. You pay us, it's generally 5 to 6% of the sales price, and we will take it from the valuation to getting the deal done with your current associate, which is a great way to do it. I mean, I'm going to tell you, if you have an associate, you don't need to hire a broker and pay them 10% to do the deal. So we do also identified buyer deals. Next slide, please.
Can I introduce one more important
Absolutely.
point to that slide?
Yes.
Obviously, I have a bias. I'm a broker with you, but I'm going to take that broker hat off right now and put my dentist hat on. And knowing what's involved with these deals, there are hundreds of emails and texts and communications between professionals like attorneys and accountants and bankers and consultants. Your life, if it is unbrokered, is going to be quite busy with the engagement of all these individuals. There is no way you'll be able to keep that confidential, and the cat will get out of the bag. Yeah. And it's going to occupy a lot of your time, both during practice and after work. So if you value your free time, and you value that production when you're at the office, you're kind of putting those two at risk, because if you have to spend time emailing back, texting back, and negotiating all the aspects of this deal, it's going to take you away from patient care. And that will translate to decreased production, which is what the bank does not want to see. You need to keep the production numbers up to maintain value so it can close.
Great point, Bogdan. Next slide, please, Stacy. All right, what's going to make your practice more valuable, doctors? Let me say it again, high net profit. Did I say that before? High net profit, one more time, high net profit. Modern equipment, computers, doctor, if you think about sellers, if you're walking into a practice, do you want something where the carpet is torn up, the chairs are 40 years old, although some of those old Belmont chairs are really, really good and steady, and the other ones that were made back in the 70s and 80s, they work really well, but do they look modern? No. Okay. Location, location, location. A practice in a non-metropolitan, more rural, maybe lower socioeconomic area may not do as well. Fee for service, including Delta Premier, this is an issue, and let's touch on the Delta issue right now. Doctors, be very aware, buyers, when you buy a practice, and I'm not going to spend a ton of time on this, most of you buyers know this. When you buy a practice, if the seller is a Delta Premier only provider, and you have to understand that 98 to 99% of the people who have Delta dental insurance have it through the PPO plan, which is about 30% lower reimbursement to the doctor than the Delta Premier plan. Okay. And Delta just recently sent a letter out to California doctors with a reduction in fees of between 5 and 10% effective January 1, is my understanding. So this is all changing and it's all fluid. But doctors, if you buy a practice as Delta Premier, you will not be able to assume that Delta Premier only status when you buy. You will have to go and network with the PPO, which means that 98% of the patients, instead of paying 85 to 90% of UCR, which is what most doctors are as Premier only providers, might be 50 to 65%. Now, again, I said, this is all fluid, it changes. So you need to take that into effect. We at the brokerages, all the brokers, we do not take that into account. We disclose. It is up to you buyers to determine how that is going to affect the practice you're buying. We do not represent. We do not say, when you buy this practice, by the way, buyer, this is how much revenue you're going to lose. We absolutely do not do that. And in the letter of intent, we don't say that. In the contract, we don't say that. These are all the things we talk about. Buyers, you just need to be aware to talk to your advisory team. Okay. I want to touch on one more thing. Oh, Bogdan, you have a comment. Go ahead.
Yes, thank you. All these things are very true and should be followed through. And again, I would summarize this slide by saying the most important thing that'll make your practice more valuable is profit, profit, profit. Because really that's the most important point of this slide. And the second thing is that when you're selling a practice to these young buyers, the buyers have traditional dental skills. If you're a 40+ year provider, you've tweaked and modified what you do, and the buyer may not be able to do those things. So in a nutshell, it is better if your practice mix is very simple: crown and bridge, fill, prophy, a very simplistic procedure list of dentistry. That's it.
And if you're a high-end producer, if you are a COIS mentor, a Spear Study Club member, if you've done lots of Pankey, if you've done LVI, I'm just mentioning some of the major continuing education groups in the United States, and you are really highly skilled, and then you talk to a buyer and you tell them all that, you want to be very careful not to tell that buyer to make it think that that there is no other doctor in America that can take over my practice. And we've had to have that conversation a lot.
Yeah.
You know, active patients, consistent new patient flow, a good thing for a buyer. Maybe a lot of the doctors in their 50s, 60s, and 70s, they don't market, they don't do social media, they don't get on Twitter, Facebook. A modern website is important. All these things. Okay, next slide, please. All right, I'm going to let Bogdan comment on some of this because he is a dentist and I am not. So we want to look at your production and procedure analysis, operative versus restorative, cosmetics, implants. So Bogdan, talk a little bit about how maybe, yeah, we're going to let you talk a little bit about your practice in a minute, but how does the mix of procedures come into play into a buyer looking at, can they buy the practice, valuation, et cetera?
Great question. And I kind of interrupted your previous slide with that comment.
That's okay.
It's really important for, as the buyer looks, and the buyer looks to see what he can do, and the production procedure mix needs to be very general. Like I said, restorative, fills, hygiene has to be very active, and there needs to be the simplistic dental treatments in the practice mix, especially mixes of implant placement, and large cases are certainly profitable, and they're a wonderful addition to any restorative practice, and they're very profitable. But buyers are looking to see what they can do, and Justin's got to probably agree with me. If the practice has a general mix of restorative dentistry that anybody can do, it's going to be easier to find that buyer to take over. It'd be easier to qualify that buyer. The more complicated the dental mix is, the more complicated the practice has evolved, the more difficult it is to sell.
So Bogdan, you and I just sold probably the highest end production type practice we will probably ever sell. It was a $3 million grossing practice, and about 40% of it were big cases, right?
Correct. Yes.
And
Full mouths and reconstructions. Yes.
yeah. So that practice is marketed completely differently than another practice that we're going to be looking at, which is 90% Medi-Cal. That's a completely the other end of the scale. So it really depends. Uncompleted treatment plans. Very important. How much work has not been done? If the seller has done all the work, what's left for the buyer? Is that seller very, very aggressive in their diagnosis and you're not? Okay, next slide, please. So profitability. Let's go through some quick statements, and then I'm gonna chime Justin back in here on this comment at the bottom. Staff's team salaries and benefits generally run 18 to 20% of the total office production. Lab is generally 6 to 9% unless you have a CEREC machine or CAD/CAM. Supplies run 7 to 9% unless you place implants, in which case they're a little higher. Advertising, if you're spending 5 to 10% on advertising, something is wrong. You're not getting referrals. You should be getting most of your practice referrals from your current patients. If you're spending 5 to 10% and you're not getting a lot of practice referrals from your current patient, does that mean that you're not really a good dentist? I don't know. Office rent, we're going to talk about that in a minute. And then my favorite is Bisnell. And Justin, I want to bring you back in here. So for 30 years, doctors, and I checked the participant list. We don't have anybody from the Internal Revenue Service on here. If we do, I'm probably going to end up, you may never see me again. But the fact of the matter is in the real world, small business owners run stuff through their practices, okay? My favorite one was a $9,500 check that one of my clients refused to tell me what it was, and it was his hair transplant. And I said, hair transplant goes right between supplies and lab. Everybody knows that, right? Okay. That was CPA's futile attempt at humor. But Justin, when you look at a P&L and you did that net profit, I think you said the net profit of that practice that you showed in your slide was $270,000. That seller is going to come back. That seller is going to come back and say, wait a minute, Justin, you're not loaning 100% because you know what? Wait a minute, I've got like $80,000 of stuff that buyer is not going to take into account.
Yeah.
How does the bank look at, we call them business expenses. One of my clients came up with this, is a combination of business and personal expenses.
So the business expenses are case by case. You will find brokers, and this is another value add as to why it's important to work with a good broker, because they're going to be able to understand what is and is not an add back. Somebody who doesn't work in the practice but was paid through the practice, that might be an add back. Your car, that's an add back, right? Some other things though, where it gets real aggressive, Costco bills, grocery bills, running utilities for your home through your practice, we're going to put the cap right about there, right? So there's an old saying that you can cheat Uncle Sam or you can cheat the bank, but you can't cheat them both. You can a little bit, but truthfully, the bank is not going to give you credit for all of that. Similarly, and we spoke about this before, Art, I had a doctor, it was a 2-doctor practice, and they had $700,000 in reported collections. For any doctor on this call that's running a practice and receiving cash payments and not claiming that is income, that we will never, ever, ever be able to give you credit for that income. So I don't know that I even need to say that, but point being is that add backs are a thing. I think it's up to Art and Bogdan to help frame it in the right way, and that the bank will give you credit and our buyer credit for those add backs. So
now, Justin, as an example, some of those unusual expenses can be considered add back. For example, let's say I hire my good friend Rachel Wall, who's a dental hygiene consultant, and I pay her whatever, 25 grand, whatever she charges, to help grow my hygiene department, okay? So if I do that, that's a one-time expense that now the practice has the benefit of that hygiene consulting training. You will allow that as an add back, won't you?
That's right. Yeah.
Yeah.
That's an example of an appropriate add back.
Yeah, so there are appropriate add backs and then there are inappropriate. So here's my saying, guys, for 30 years, 35, 40 years, you have won the war. I mean, you have basically saved a boatload of money in taxes, and you've run this through and you haven't gotten audited, and good for you as a CPA. It is what it is, right? But now if you're a year or two before, and remember, Justin's going to be looking at, if you're selling your practice now, he's going to look at 2021, he's going to look at 2022, maybe he's going to look at 19. We pretty much throw 2020 out because of the pandemic. Now is the time to clean your act up. You've won the war for 30 years. Now maybe we lose a battle here and there so that your practice is truly showing the profit that it shows. And then, because remember, think of the psychology, okay? With all due respect to my dear friend Justin here, what Justin's bank, Bank of America, chooses to lend does not dictate what the value of a practice is. It is specifically what Bank of America, under their underwriting rules, chooses to loan to this doctor at this time on this practice. Okay, but in a buyer's mind, the buyer's saying, well, wait a minute. If the practice is listed at 800 and Bank of America chooses to loan 650 for these reasons of lack of profitability, well, maybe this practice is only worth 650. And we get a lot of that too. So that's why you got to be really careful. Next slide, please. All right, and now, well, we've had many words from Dr. Madurowicz, but Bogdan, by the way, that's a great picture of you. I was there when we took that picture.
Yeah,
that's a really good picture. You clean up pretty well, from what I can tell. So basically, I'm going to let Dr. Madurowicz take a couple minutes, tell you a little bit about his practice and some of the psychological thought patterns of a seller, because doctors who are looking at selling, you're going to go through this, and he's already done it. So Bogdan, take it away.
Thank you, Art. So a little bit about me. I've been 5 years out of retirement working with Art selling practices, but prior to that, there was about 33 years of private practice in San Diego, where it was mostly a adult cosmetic practice, employing 10 individuals, making, producing production numbers of 1.1 to 1.3 on average. So a very successful fee-for-service practice model. As a seller, my situation, as I mentioned before, I was actually kicked out of the practice, out of the career a little bit early. I had plans to retire 5 years from the time that I retired, but because of a physical issue with my hands, it was important that I find the right buyer and sell. So the staff knew, and I went through all these emotional events in finding the right replacement, and then finally, with the right exit strategy, moving away from practice and into retirement. A couple emotions that you can expect after so many years working with patients and staff and so forth is, it's a big change in your life. So for the most part, the sellers need to be prepared for, the onslaught of these emotions that will quite honestly overwhelm you. You're basically saying goodbye to a large family that you've created, not only the patients, but the staff that is part of the asset value of the practice. You're going to be not receiving those pats on the back that is one of the most attractive things as a dentist. You improve people's smiles, their self-confidence, and you kind of thrive on those pats on the back from doing your dentistry. So these losses of this secondary family, of the pats on the back for doing the right thing, and the personal context that, these relationships develop. You're not going to hear the stories of your patients again. Is takes a big emotional toll. When I had to be telling my patients that I'm retiring and I found a wonderful replacement, tears did well in my eyes. It was a big emotional event. So you need to be not only physically ready to sell your practice, but you need to be emotionally prepared of what is to come. Taking a step back about, are you ready? Because Art mentioned that in the very beginning. It's the first question that we ask is, are you ready? Well, I just alluded to the fact, are you emotionally ready? Are you financially ready? Is what Art brought to the point. And are you physically ready? Asset-wise, is the practice ready to sell? Is another question that you have to address. As far as talking about the physically ready, is the practice ready to market, to sell? Is the profitability there to create an attractive asset to acquire, which was just a couple slides ago? I would say that if you have 1 to 2 to 3 years out before you plan on selling, you've got some work ahead of you. And one of the most important things, if we're going to be valuing your practice based on profitability, is you need to clean up that P&L. Those Costco runs, the auto charges, you need to consider whether or not it's worth running them through the business, or is it worth paying it outside of your personal income and selling an asset that has more profitability. One way to look at it, and let's take some simple numbers, you're producing $1 million, and let's say we're selling the practice at 80% as a round number, that would be an $800,000 asking price. If the practice is producing about 40% profit, and you go 2 times to 2.5 times of that net, then you're in the 800 to 850 to 900,000 of the asking price. Let's take that profitability, and let's say you're running $10,000 of stuff through the business. And so it's going to decrease your profitability by $10,000 if you pay it, if you're running it through the business, it's going to decrease the value of the profit based on the amount of cash flow that it creates. If you take a percentage of that, the number is going to be a lot smaller than if you multiply it by the multiple. So it makes sense to not take it through the practice, pay taxes on that, and therefore you'll get a higher asking price on a sale. So cleaning up your P&L, removing all those little add backs that you used to take, and essentially stop winning those battles with the IRS, it's going to net you a lot more money on the sale. So clean up the P&L is important to do, make it more profitable. It'll increase the sales value. Cosmetically, is the practice ready for sale? You might want to do some little things. The old dental equipment has value. Get the chairs recovered, keep the old equipment, don't buy a whole new chair. Consider, getting some paint, some simple items. And that's what I did when I sold my practice. I put a fresh coat of paint, I replaced the carpet, I put some wood floors in. So when the buyer comes in, the house, the practice looks like it's been well taken care of. That's all part of the staging of the sale. It's important to clean house, declutter, and stage the practice well for the sale. In my transition, these emotions were pretty heavy, and quite honestly, it took me a little bit of time, and it really didn't hit me till about 3 months after. But once I retired, it was a good place to be, and I was really happy I had a broker because it certainly made the transition a lot smoother. And as I just mentioned, I feel the broker brings a lot of value in this transition. Art?
Okay, yeah, I'm typing into the chat. Let me just finish doing that. Creating and living a fulfilling. One of the things that we see by Alan Spector. Yeah. On my podcast, one of the things that we have our guest that came out 2 days ago is a gentleman by the name of Alan Spector. And Alan wrote a book called Your Retirement Quest, 10 Secrets for Creating and Living a Fulfilling Retirement. He gives some really interesting insight into retirement. Number one, 43%, the average retirees, the average retiree, and this, the name of the book, Stacy was kind enough to put into the chat. The average retiree spends 43 hours a week watching TV. The average retiree with a negative attitude will live 8 years less than someone with a positive attitude. Alan talks about a 2 a.m. friend, talks about charity, talking about giving back. I have had a couple of doctors in my conference room in tears, literally saying, you know, Art, I've been doing this for 40 years. I don't know anything else. I'm scared of what's next. So I'm going to encourage doctors, your sellers, if you're looking at the next 1 to 2 years, go to the next dental convention, but don't look at buying impression materials. Look at what type of a job might you do after you sell. For example, Dr. Madurowicz, what was your second career after you sold?
Well, I didn't have a plan. It just sort of landed on me. And I've got to say I failed in retirement because pretty much within a year after retiring, the opportunity came to work with you. And I certainly am happy of that because it allowed me to continue working in a field that I was very comfortable with, continue to work with, my peer group, other dentists. And so it brings a lot of, joy and opportunity to continue the conversations.
Yeah, it could be a teaching job. It could be a job working with one of the major dental companies, Shine, Patterson, Benco, things like that. So anyway, let's go to the next slide because I've got 15 minutes left and a lot of stuff. Quickly, your office lease. If you don't take anything from what we tell you today, please, please, please make sure that 3 to 5 years from now, or sooner if you're closer, that you have a dental specific attorney. Pat Wood talked about this on our last webinar. If you attended, if you didn't, it's on our YouTube page. Have a dental attorney review your lease. I can tell you nightmare stories. I sold a practice. We talked about this on the last webinar. I ended up having to deliver a $50,000 check to a landlord so he let the seller have the buyer assume the lease. There are recapture clauses, assumption clauses. I'm not getting into detail on this because I don't have time. Have a dental specific attorney, 3 to 5 years. If you've got it, or if you're going to sell in the next 6 months, do it now. Review your lease and make sure that it's all set up for you to be able to sell. Assumption clauses. If you think you have 2 5-year options, if those clauses are personal assumptions, meaning you are the only one that can assume them, then you may not have. You may have 6 months and then the landlord's got you. So there are clauses in, I just sold a practice clause that said the landlord gets to get a portion of the practice sales proceeds. They exist. Are they legal? I'm not a licensed attorney, but you got to deal with them. Next slide, please. All right. Buyers, if you're going to do a due diligence, my dear friend and partner in my practice, in my CPA practice for 33 years, Pam Chamberlain, she has done hundreds of due diligences. The way we work in our CPA practice is that if I'm the broker representing the seller, and by the way, one more thing about brokers. Brokers can represent in California, in other states it's different, but in California, I can represent both the buyer and the seller. I would cut off my left arm before I would be a dual agent. That is a total conflict of interest, period. So if we're selling a practice and I'm selling the practice to a non-CPA firm client, my dear friend Pam cannot do the due diligence for the buyer because that's a conflict. But if I'm selling a practice and to someone, and it's not, I'm selling the practice. If I'm not selling the practice, if I'm not the broker, we do due diligences all the time. So buyers, when you're looking at the numbers, you're going to need to provide Pam, and the bank's going to ask for some of this too, 2 years business tax returns with statements and depreciation schedule, 2 years of profit and loss statements, general ledgers. The general ledger is the accounting document that shows me what is the $54,000 in dental supplies. Are they all checks to Patterson or Shine? Are they other things? 2 years complete bank statements for deposit verification. I had one sale, I basically fired them as a client because we found out during the process that they would make deposits of personal money into the bank to artificially inflate the revenues of the practice. That is fraud. We don't do fraud on Fridays or any other day. Next slide, please, Stacy. 2 years of payroll reports. I want to see who's on the payroll. I want to see how much they're making. 2 years of monthly production and collection reports. We want to compare the monthly production and collection reports to the general ledger, to the bank statement. So we have 3 or 4 different things to verify. Current complete aging of receivables. I mean, if I have a practice that has the average is 65 to 75% of 1 month's production should be your accounts receivable. If the receivables are 2 or 3 times, that either means you haven't purged your receivables since the 70s, or it means that you're not collecting money. And now you're the buyer, you come in, you got to pay a loan payment, and you say, Mrs. Smith, I need you to pay. Well, wait a minute. Dr. Madurowitz never made me pay my bill on. What is up? I'm going somewhere else. That's what happens. I want to see the fee schedule and a broker summary if it's available. Next slide. So what are we looking at, buyers? What's going on in the practice? And sellers, be aware of this too. Are there family members working? Are the family members going to continue to work in the practice? Probably not, maybe. Has there been an associate that's there for over a year? If there has, have they developed allegiances? And why are they not buying the practice? That's what you got to ask. What does the hygiene department look like? We had one practice that we sold, and the buyer knew and was informed that the hygienist was the doctor's wife. And the doctor's wife absolutely did not believe in any type of non-surgical periodontal maintenance. No root planing, none of that. And that was a big problem until that doctor's wife left, because that doctor's wife had the relationship with all the patients. Big deal. Look at the sellers' websites, read their reviews. If there's, we all say we want 100% 5-star reviews. That doesn't happen. But if we have lots of bad reviews, the work was bad, it had to be redone, you might reconsider it. Look at, that's not on here, but look at their social media accounts. What do they do? What are they about? What are they into? Are there other locations? I mean, guys, if you're buying a practice and that seller has a location 3 miles away, I'd be really, really wary about that. And does the seller work in other offices? Because there's other sources of income reported on the tax return. These are things that buyers you should look at. Next. Make sure the dental lender, Justin, make sure the dental lender receives the same information as the dental CPA and the dental management consultant. I don't know if this happens, but we just got to make sure that we're fully transparent. That's important. You ever see that in that where you look at a tax return and say, gee, Art, that doesn't look right to me? Not usually, but sometimes, right?
Yeah. No, I mean, not as often with you guys, right?
No.
And I think we can, but yeah, it also speaks to the seller. I mean, if they're doing, some level of cheating or whatever you want to call it, there's some mischief on the returns. I mean, where else might it be hiding? So It does cast some doubt.
Yep. Here's a big one. Is the practice collecting copays? I am not a licensed attorney, but I know pretty well that it is an insurance fraud if you don't collect copays. I had one doctor who told me they were not collecting copays, and I refused to list their practice. Think about it this way. The seller is not collecting copays. Now the buyer comes in and says, wait a minute, I have to do that. And all the patients say, wait a minute. The seller never did this. What are you trying to pull here? I'm going to find another dentist. Does the seller own the building? Do we need to make an adjustment to fair market value rent? Do you get to buy the building? Is the seller paying employees correctly, independent contractor employees? So these are all the reasons that you want to have a CPA, a dental specific CPA, do the due diligence for you. Next slide, please. quickly, let's talk about the allocation of the price for tax purposes. This is my bailiwick. We have conflicting things that go on here. Okay, the seller wants to allocate the majority of the sales price to goodwill because the seller gets capital gain treatment at a maximum federal rate of 20%. It's 15 to 20%, usually 20. But anything we allocate to dental equipment is taxed at a maximum rate of 37%. So in the allocation of the price that's done between the buyer's CPA and the seller's CPA, the rule of thumb is 15 to 20% of the sales price will be allocated to the equipment and the rest to goodwill. A covenant not to compete, you don't want to allocate a lot to that because that is treated as ordinary income to the seller. And a covenant not to compete on the buyer side and goodwill are both amortized over 15 years. Sellers, be very careful. If you bought a practice and amortized goodwill, and that was allowed after August 10th of 1993, you're going to have amortization, and you're going to have amortization recapture, and you're going to have more ordinary income. So if you're amortizing goodwill, seller, you better check with your dental CPA. If you check with your CPA, because you might have more ordinary income than you want. So that's an allocation between the buyer and the seller, and it's negotiated. I do not like when brokers put an allocation in a contract. I do not like when attorneys put an allocation in the contract. That is the CPA's job. Next slide, please. No major tax law changes on the horizon. Come see us on December 2nd when Mel Schwartz and I talk about that. A lot of tax law change is going to depend on what happens in, about 30 more House races and Arizona, Nevada, and Georgia. Once we know what happens there in the election, which we'll know in the next 30 to 45 days, we'll be able to tell you what the tax landscape looks like. Rates will be indexed very, very well for 2023. You might consider putting a sale up to 2023. California rates are as high as 13.3%. For sellers, if you're more than 3 years out, consider setting up a defined benefit pension plan. We had a doctor that we did this planning for. It's great. He put $155,000 in the plan year one, $155,000 year two, and the year of the sale, bam, we hit the plan with $400,000. And it was wonderful. So don't have a lot of time to get into that. Next slide, please. All right. When you're buying, most all of you are going to set up as S corporations. If you are a seller and you are a C corporation, you must, unless you want to get double taxed, you allocate to personal goodwill under the Norwalk case. The Norwalk case was a bunch of CPAs in San Francisco who said, wait a minute, the goodwill is not with the corporation. The goodwill is with me, the doctor, which is true. So therefore, the personal goodwill avoids double taxation. Also, if you have elected S corporation in the last 5 years, you also have potential double tax. If you have issues with that, my number will be at the end. I can help you with that. My team can help you with that. Like I say, brokers should leave it to the CPAs. A good CPA will never kill a deal over allocation. We said 15 to 25%. Next slide, please. Here's a sample allocation. Sales price 600,000. You know, this might be 150 to equipment. This might be a little high, but just an example. 10,000 supplies, 10 to covenant, 430 to goodwill. Next slide, please, because we're getting to the end here. Real quick. Working back as an associate, great idea in theory. You know, we run the numbers, 1.3 million. So next slide, Stacy. I just want to touch on this. When you sell off part of your practice, you're getting a lump sum of money. And if you're going to basically give up part of your income, you need to plan on that. Okay. So the associate's probably making 100 to 200,000, has a family, et cetera. And they can't take as much of a pay cut. I just want to hit one more point and then we're going to call it a day here. Go ahead, next slide, Stacy. So if I got a 1,600 square foot, 6 treatment facility, we did 1.4, 1.1 is done by the senior doctor, 300 is hygiene. Senior doctors working 4 to 5 days a week, getting burned out. Want to spend more time with family. Next slide. So what we're going to, next slide, Stacy. So we're going to basically have a 1 to 3 year associate. We're going to have the associate doctor by 25% of the senior doctor's practice. Nice bite-sized Pete, value at $280,000. The senior doctor can put the facility up as collateral for a note. We generally don't have banks financing associate buy-ins. So let's go through an example. Next slide, please. So as is right now, I got collections of 1.4, profit of 400. The senior doctor's earning 280, the associate 120. If the practice grows by 20%, the associate's going to earn 180 and the senior doctor 420. Next slide, please. That's eat what you kill in a partnership. Here's a hybrid model. So we have a hybrid model where the total practice is 600,000 of profit. So tier 1, 30% of production. The senior doctor gets the 30% of 700 that he or she produces. The junior doctor gets 30% of 500. And then the rest of it is based on equity. Okay, so there's two different models. I wish I had more time. Next slide, please. I don't have the time to get into steps taken to sell. So let's go, just keep going, Stacy, because it's 10:59. I want to be respectful of everybody's time. Keep going, next slide. Last thing, what professionals? You want to have buyers, you want to have a dental CPA, a dental management consultant, a dental attorney, and a dental equipment representative to test and review the equipment. Those are the team, that's the team, the buyer that you need to have and lean on them. Next slide, please. Incorporate, we recommend generally all of our buyers incorporate as S Corps, plain and simple. In other states, it can be a limited liability company. All right, Stacy, go to the next one after this one. Don't have any questions on here. Folks, it is 11 a.m. Hey, not bad, Bogdan, right on time, huh? I want to thank you, ladies and gentlemen, for the honor and privilege of your time. You will be receiving an email to be able to see this presentation. Our contact information for all three of us is up here. Please feel free to lean on us. Sellers, if you have questions about selling your practice, Dr. Madurowitz and I can help you. Buyers, if we're not listing the practice, we can help you with due diligence, answer your questions. And guys, if buyers, if you're looking at buying a practice, or sellers, if you're looking at expanding a practice, anything, Bank of America they're just outstanding. That's all I can say. I'm very careful of who I affiliate with. And the folks from B of A I've worked with for over 30 years. Justin is fantastic. Their whole team is fantastic. So with that said, Stacy, thank you for your help. My up and down arrow didn't work, so thank you for advancing my slides and for everything you get and the guys that, ladies and gentlemen, I barely do to help us. Justin and Bogdan, thank you for your great insight today. Folks, remember to join us on December 2nd, Friday, 9 to 11, when Mel Schwartz and I are going to go over year-end tax planning, and then December 9th for the third of our webinar series. I hope that this information has been helpful to you. And, buyers and sellers, think about this. Plan, give us a call if we can help you. And with that, Bogdan and Justin, we'll talk to you soon. Thank you so much, guys.
Thank you.
Yeah,
all right.
Thanks for having us.
And we'll call it a webinar. Have a great weekend, everybody. Happy Veterans Day. Bye-bye.